SPACs, Special Purpose Acquisition Companies. Now, you may have heard of this term, you may have not, but these blank check companies are making massive waves in the finance sector of the cannabis industry. So, in this video, we're going to help you to better understand what SPACs are, their limitations, and how they're actually impacting the cannabis industry. Now, if you have any questions about finance, audits, due diligence, or anything cannabis business related, then please reach out to us via our website at greengrowcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation. So again, today our topic is cannabis SPACs, which are special purpose acquisition companies. And this presentation is brought to you by Green Growth CPAs. Now, before we get started, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we're going to cover in today's video. So first, we're going to talk about and understand what is a SPAC. And then we'll talk about how SPACs raise money. Then we'll talk about some context and considerations and thoughts around cannabis SPACs. Then we'll jump into some limitations about SPACs, and lastly, some final thoughts around SPACs for your cannabis business. So first, what is a SPAC? You may have heard this term, you may have not heard this term, but SPAC, or SPAC, it stands for Special Purpose Acquisition Company. Now, SPACs are sometimes called blank check companies, and the company has no established business plan, and it's solely used to merge with or acquire another business entity. And SPACs are publicly listed on stock exchanges or markets, and they raise funds through an IPO, and later they use those funds to acquire that new company. And SPACs, or blank check companies, are considered penny stocks or micro-cap stocks by the SEC. So that being the case, these companies must abide by specific SEC rules and regulations. So there is some type of official oversight on these special purpose acquisition companies. And just for context, SPACs make up about 20% of the US IPO market as of 2019. So now that you understand what special purpose acquisition companies are, let's talk about how they actually raise money. Now, at the start, before these companies form, the entrepreneurs and investors are going to agree on a general plan of what they want to buy. But it's important to know that these blank check companies don't list what they're going to buy. But you can infer what type of company it will likely acquire based on the skill sets and the expertise of the founding partners. From there, after they have that general plan, the SPAC is going to raise money through an IPO. And so what they do is they pool money from investors, and this is known as a blind pool, and they put that into the public company. Now, the money is typically placed in an interest-bearing trust until the capital is actually deployed. Now, once public, the SPAC can go out and make acquisitions or investments based on a strategy defined by the company's managers. The SPAC will find a company it wishes to acquire, and it brings the deal to the people who invested into the SPAC. Now, these shareholders can approve the deal if they want to invest in it, and if they don't like the investment option, shareholders can use what's called the redemption right and ask for their money back. And it's important to know that SPACs usually have 2 years to make an investment and deploy that capital. Now, you may be saying, great, this is all good information, but I've never seen this before. Well, there are plenty of examples of SPAC acquisitions outside of the cannabis industry that many people have heard of. IPOs by DraftKings, Virgin Galactic, Nikola Motor, these were all achieved through the use of the Special Purpose Acquisition Company vehicle. So now that you know what SPACs are and how they raise capital, let's talk about cannabis and SPACs and the industry and how these are actually affecting the industry and how they're working within our industry. Now, SPACs have become more and more common as a way to invest in cannabis companies. They're an appealing alternative to venture capital or private equity investors who tend to typically shy away from investing in the cannabis industry because cannabis remains illegal at the federal level. So an example of these being more commonplace, you saw Credit Suisse and Citigroup, they've each led US IPOs for companies that are looking to invest in FDA-approved cannabis therapies or technology that supports cannabis companies. You also saw JP Morgan and Goldman Sachs, they've helped existing clients with cannabis-related deals, though their clients don't sell or cultivate cannabis THC plants themselves. And lastly, BNY Mellon is providing services to a US-listed cannabis ETF. And there are a few big names dominating the cannabis SPAC market. You've got two major groups, Collective Growth and Green Rose Acquisition. They've raised $150 million each. And just for context, that's more than all of the cannabis and hemp IPO activity in 2018 and 2019 combined. And there are other big players. You've got Stable Road Acquisition. They did an IPO for like $170 million. You've got Meridia Merger Group. They did an IPO for $120. You've got Silver Spike Acquisition, $250 million. So for a privately held cannabis company, a SPAC is a solid way to raise a lot of capital into a stable company and gain the liquidity that you're looking for. But you will surely need to actually build a company worth being invested in. And these are large amounts of capital being deployed into cannabis from sophisticated institutional investors. So the bar is going to be higher. The due diligence is going to be more granular. They're going to really want to peel open your company and see all the drivers of revenue and all the drivers of expenses and how tight your financial plan and operation actually are. On the screen now, you can see a list of US and Canadian exchange-listed SPACs that are specifically for cannabis. You can see their tickers, the exchange they're on, the date of their IPO. So this is groups from 2017, 18, and 19, and some 20s in there. And then you can see how much money they raised. So this sounds like a great way to raise capital, but what are the limitations and risks of special purpose acquisition companies? Now, the SPAC has constraints that don't exist with other investment vehicles. For example, the SPAC has to spend at least 80% of the funds on one transaction. So when you see $150 million being raised, that means they need to deploy about $120 million in one company. So we're looking at big investments here. And another constraint is that for the cannabis companies, they're going to need 2 years of audited financials and corporate governance with independent board members. And that's a very high bar to jump for many cannabis businesses. Most don't even pay their taxes properly. So if you have no way to look at the financials, audit them, have a third party do the proper due diligence, there's no way that you're going to raise money with a special purpose acquisition company. Now, it's important to understand that SPACs are not permitted to buy federally illegal businesses in the U.S. when they are listed on the New York Stock Exchange or the NASDAQ, even if the business is legal at the state level. But this doesn't deter Canadian SPACs from investing in these U.S.-based cannabis companies. And since these US-based SPACs cannot buy federally illegal businesses, that means in practice, this method of going public privileges the non-licensed ancillary cannabis businesses and US hemp businesses that are legal on the national level. Akerna is an example of a non-plant touching ancillary business that went public through a special purpose acquisition company. And they are a parent company resulting from the merger between MJ Freeway and MTech Acquisition Corporation. And they were the first US-listed SPAC focused specifically on acquiring cannabis technology companies. So really what we're showing here and explaining is that the way your cannabis business is structured, how your IP is created and then licensed to the company, as well as how you generate your revenue is incredibly important if you want to be considered for investments from special purpose acquisition companies. So, final thoughts, all things considered, should you sell your cannabis company to a special purpose acquisition company? Well, if you meet the strict criteria and you want to get out of your business, then yes, it's something you should consider looking into. And many cannabis SPACs, they're raising huge sums of money, but the pool of companies eligible for acquisition, again, due to the constraints, is limited for those variety of reasons. Now, you may be able to sell your private company for more than fair market price if you fit the right profile, because there's not a lot of deals, but there's a lot of money, so every deal is getting combed over, very detailed, and people are going to deploy the capital because they're on a time constraint as well. But it's also important to understand that money isn't everything. And as with any acquisition or merger, the option of selling can often mean that the founder, the managing partners, they get ousted from the company and employees may get laid off. Your company, or even just the intellectual property of your company, may get absorbed into a larger parent group, and then that's it. Your company's gone. They just wanted you for your IP or for your SOPs or for whatever other reason. But SPACs are a good way to raise funding and stay in control of your cannabis operation, provided that you find the right group of investors that don't just buy and kill your business. But every situation is unique, and you're going to need proper due diligence to determine your eligibility and your prospects of raising capital through SPACs for your cannabis company. So hopefully this presentation has brought you some value and helped you to understand a little bit better what special purpose acquisition companies are and how they tie into the cannabis industry. Now, if you need help with due diligence or audit support for your cannabis business, whether you're going to be purchased by a special purpose acquisition company, or you're doing other M&A deals, or you're an investor and you want to go deploy some capital, but you don't know if this company is the right fit for your investment thesis, then please reach out to us. We can help you with audits, due diligence, in any respect, whether it's operationally, financially, and all of the above. So again, reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. You can leverage our experience. We work with hundreds of active clients that are, the $100,000 operators per year, all the way up to the public companies doing $25 to $50 million per year in revenue. We've seen all types of companies in every vertical, and we can give you a lot of color and context, and we can help you with that due diligence, that audit support to help you get a grip on your numbers, help you understand if you're a founder, is your company profitable, where can you find some efficiencies and cut down on any financial friction in the business, as well as if you're an investor, how's your money being used? How's the company performing? Don't just rely on emails from the founders. Have a third party go out there, peel back the company, learn what's going on, and then give you some color and context in an audit document to know how the business is performing. So again, if you need help with this, please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.